for our webinar on financial planning tips for working professionals. Just a reminder, if you could please mute your microphone and your camera, that'd be great. As a firm, we talk about the importance of what it means to do the right things when you're in the accumulation stage of your life. And we talk about how if you implement the ideas that we're going to review today, really, you can almost put everything on autopilot until you get closer to retirement. And you're going to be putting yourself in a great spot that when you retire. So it's about knowing what to do and then implementing these ideas. Today as presenters, we'll have Samantha Macy. She's an associate wealth advisor and marketing coordinator here at the firm. And Vincenzo Testa, he's also an associate wealth advisor and tax planner at the firm. Vincenzo's a CPA, and both Samantha and Vincenzo are in the process of getting their CFP. The 4 topics that we'll be discussing today are budgeting and debt management, saving for retirement, maximizing employer benefits, and risk management. So without further ado, I'm going to hand this over to Samantha to have her go through budgeting and debt management.
Thank you, Marty. Hi, everyone, and thank you for joining us. So let's jump into budgeting first. Budgeting is a simple yet effective way to plan for your future and improve your financial picture. Now, it's important for 2 reasons. First, as an accumulator, as Marty was talking about earlier, it's important for you to figure out how much you can be investing and saving based on your budget. Second, as you near retirement, it's important to understand your budget so that you understand how much money you're going to need in retirement for your expenses and to be able to plan for that number throughout the life of your retirement plan. So how do we do this? First, we're going to talk about tracking your spending. Now, there are a number of tools out there that make this easy for you. There are apps that you can download. There is mobile online banking that we're seeing an example here in this picture to the left. And there's also planning tools out there. Now, I know that with my mobile banking, I have access to information such as this picture that we're seeing here of my monthly spending broken down by categories and also an average number per month and per year. So it's a great tool to use just to get a kind of a snapshot of where you're at and to understand here are some areas that maybe I'm not spending enough or I'm spending too much. So it's just good to get a full understanding of your financial picture. One of the foundations of budgeting is to spend less than you earn. Now, this is a very simple foundation aspect of budgeting, but it's very important. You don't want to be overspending, and that's why we're trying to get a full understanding of your cash flow needs. You want to optimize big budget items first. For a lot of people, this is their housing and transportation costs, but for some, it might be student loans for yourself or maybe for your children that you're helping to pay for their student loans. So look for ways to optimize those items. Maybe that's refinancing or consolidating loans. You also want to have an emergency fund set up. Now, what we recommend is 3 to 6 months of your expenses set aside in case of an emergency. You know, maybe your car breaks down or God forbid you lose your job, you'll have some funds set aside for that emergency instead of having to take on any unplanned debt. Lastly, calculate how much you can save and invest. Now, you can do this by taking your income, subtracting your spending, and looking at that number to see how much of that are you willing to save and invest into your retirement plan. Next, we're going to talk about debt management. So let's talk about the types of debt that you have. It's important to take stock of the types of debt, the amount of each debt, and the interest rates associated with those debts. Now, there are essentially 2 types of debts. There's good and there's bad. And not all debt is bad, unlike what some people believe. So let's take a look at this graphic that I have to the right with some definitions. Good debt is defined as debt that increases your net worth or helps you generate value. Bad debt is debt that does not increase wealth and is used to purchase goods or services that have no lasting value. So what automatically jumps out as bad debt is credit card debt, right? For a lot of people, that is a pitfall. If you are having a balance on your credit card that you're not paying off on a monthly basis, then you're overextending your budget. You really want to be paying this off on a monthly basis and not taking on that interest rate, the high interest rate from a credit card that would move forward with those future payments. Some good debt examples are mortgages and student loans. A mortgage increases your net worth by purchasing property. Student loans are a good debt because you're investing in your future income, or maybe your children's future career. And this allows you to invest in your income and future savings amount. Now, you want to be responsible with these types of debts and make sure they're not falling outside of your debt parameters for your budget. If they fall outside of your parameters, then they would become bad debt, because too much of any debt is bad debt. Some ways that you can make sure that you're optimizing this, like we were talking about earlier, is maybe it's time to look at refinancing your debt or consolidating your student loans for a lower interest rate percentage. If you can decrease this percentage by 0.5% to 1%, that might be beneficial to you. You could be saving yourself thousands of dollars. A good rule of thumb for student loans is try not to borrow more than your expected first year's salary for your education. A rule of thumb for your mortgage would be you should not spend more than 28% of your monthly gross income on a mortgage payment. And lastly, you want to be strategic with what you choose to pay down first. You want to pay down the loans that have the highest interest rate first and move down the list from there. So I was talking about good debt, and let's talk a little bit about how you can be leveraging that good debt. A manageable amount of debt at a low interest rate can provide a benefit to you. And here are a few ways that I have listed here. First off, it saves you money by refinancing while interest rates are low. Second, it gives you the ability to invest excess funds that would have otherwise gone to paying off debts. Third, it gives you the opportunity to increase your credit score through consistent debt payments. Now, what we're looking at on the left is a chart of the 10-year Treasury rate over the last 60 years using historical data. Now, if we look, it really should give you an understanding of the interest rate picture that we've heard so much about how interest rates are so low. If you look in 1980, you can see there was a peak at that point, and where I have circled in yellow, the below right corner, is the last few years of the historically low interest rates. Now, in a normal interest rate environment, paying off debt makes sense, but with the historical low rates that we've been seeing, taking some of these strategies that we've been discussing and leveraging that good debt would be beneficial to you. An example of this would be, instead of paying off your mortgage with a reasonable rate at an earlier time, instead pay it off at the normal schedule and invest your extra cash flow that would have gone towards paying off your mortgage early. Now, again, a warning, good debt is good in the right amounts. Too much debt of any kind will negatively impact you. So next, we're going to discuss saving for retirement. First off, if your employer offers an employer retirement plan, you should be taking advantage of it. And the first thing that you should be doing is starting to save now. With retirement plans, some of the largest items that impact your plan are your time horizon, your consistency with saving, and the compound interest. So starting to save now is the first step that you can take. Now let's look at this graph that I have here with a great example of compound interest. What we're looking at is investor one starts saving at age 25, sets aside $5,000 a year for 10 years in a row, and stops investing at age 34. Investor two starts investing at 35, invests $5,000 each year for 30 years, and stops at 65. So investor two invests for 30 years and investor one only invests for 10 years, but at an earlier point. point. Now, if we look at the account balances at the end of their retirement saving years, so at age 65, investor one actually has more funds in her account than investor two, which is a really impactful way to look at how compound interest works. So now we're going to talk about contributing to employer retirement plans, and we have a few guidelines for you. A good rule of thumb is to contribute 10 to 15% of your salary. And at the very minimum, we want you to be taking advantage of your employer contribution match. Now, for most people, the employer contribution match is between 3 and 5%. And so we want to make sure that you're at the very minimum taking advantage of that. You have an example here in this image to the right of an employer match is 3%. So the employee is also contributing 3% to essentially capture that free money that the employer is willing to invest with them into their 401k plan. However, if you're contributing this rate of 10 to 15% of your salary, you're almost always going to capture your employer contribution match. Next, we want to talk about selecting proper investment allocation. For all working professionals, unless you're within 5 years of retirement, you should be allocated towards growth. And when we say growth, we mean 80% equities up to 100% equities. If you're nearing retirement, that's when we would have a conversation of how should you be more properly allocated for that point in time, and what is your need in retirement to make sure that your growth rate matches your need throughout the life of your retirement goals. Now, when you're invested properly at this allocation, for an accumulator, this is really beneficial, especially during times of volatility, because essentially you're buying into the market at depressed cost for stock, so almost at a discount. And then when the market goes back to normal, you will experience growth in your account. Another item for you to consider are Roth contributions. So Roth contribution is we're not talking about opening up a Roth IRA, a separate account. We're actually talking about making Roth contributions within the 401k itself. Now, not all plans allow for this, so check with your employer and see if that is something that is available to you. But what this essentially is contributing money post-tax, so it's taxed when you contribute, but then it grows tax-free, and at retirement, you get to take that money out tax-free. As compared to pre-tax contributions, they're not taxed initially, they grow tax deferred, but then when you withdraw the money at retirement, then it is taxed. So it is actually a great idea for you to be filling up both of these buckets in your 401k plan, your Roth bucket and your pre-tax bucket. And when you're younger, this is especially beneficial for you because you are at a lower income tax bracket. Therefore, you're not going to be taxed as high as you would later in your career. However, it is also beneficial for those that are in later career because you are still filling up that Roth bucket. And for some of you, you might be phased out of contributing to a Roth IRA because your modified adjusted gross income is above that phase out limit. So the further along you go in your career, we would want you to consider splitting the difference. Maybe you would do half of your contributions to Roth and half to pre-tax. So before this webinar, we actually received a client question that we wanted to address. We thought it was a great one for this purpose. So the question is it worth contributing to a company 401k if there is no match? The answer to that is yes. 401k plans are excellent tax-deferred retirement savings accounts, even if you don't have an employer match. Now, there are a few reasons for this. I just talked about how if you are above the modified adjusted gross income phase-out limit, you can still make a Roth contribution within a 401k, which is a great benefit. You also are making systematic investments over a 12-month period. So essentially, you're dollar cost averaging your money as you contribute consistently, no matter how the market is performing. Third, the amount you can contribute is high. In 2022, the amount that you can contribute to a 401k is $20,500. And anyone age 50 or over is eligible for an additional catch-up contribution of $6,500. Now, when you compare this to a Roth or a traditional IRA account, those limits are actually $6,000. And if you're over 50 or 50 or over, it is $7,000. So there's a big difference there. Now I'm going to hand it off to my colleague Vincenzo Testa to talk about maximizing employer benefits.
Hi, everyone. So health and life insurance is two of the most important employer benefits that employers offer alongside the 401k and other employer-sponsored retirement plans. So let's talk about life insurance first. When you're choosing your life insurance policy, you need to be aware of the needs of the life insurance policy based on your age. So just be aware that when you're younger and healthier, that your premiums are going to be much lower, obviously, because the insurance company has less risk of payout. So they allow you to pay a lower premium amount, as opposed to when you're older, your premiums are a little bit higher because there's obviously more risk of payout from the insurance company, and they want to make up for that through your premiums. Another benefit that employers offer is a supplemental life insurance. So some employers will offer life insurance by default at no cost. Then there's also an option to get supplemental life insurance and pay a little bit more every week out of your paycheck and increase the payout amount that the life insurance policy will allow. So these are typically more affordable than comparable individual policies. So if you were to get a policy through an insurance broker, the employer-sponsored life insurance supplemental life insurance would be more affordable usually. In regards to high health insurance premiums, just like the life insurance premiums, there's low premiums and high premiums. And when you choose the low premium plan, the deductible will be higher because you're making lower monthly payments. So when it comes time to actually utilize the insurance, the deductible is at a higher cost because of your lower premiums that you're making, and vice versa. When the premiums are high, the deductible will be low. The last health insurance related benefit that allows you to help manage your healthcare expenses are HSAs, or health savings accounts. So you're allowed to contribute as an individual $3,650 into an HSA account in 2022. It's increased from $3,600 in 2021. And you're able to invest this money as well as let it sit in cash. It's only deductible though if you're spending the account balance on qualified healthcare expenses. If you were to go to the store and buy food with it on accident with the card that they provide you, then that would not be deductible, and you'd actually be subject to penalty and tax on the distribution. And for family plans, the contribution limit is $7,300. Some other fringe benefits that employers offer that could be really useful. A lot of people don't look into the benefits, all of the benefits that your employer offers. So here's some really nice perks that a lot of employers offer. You have a tuition assistance or tuition reimbursement. I mean, that's a great perk. You obviously utilize that if you can. A lot of younger professionals will get their master's degree, or as Sam and I are taking the CFP, Certified Financial Planning exam, and we are receiving that tuition assistance per se. It's just a great perk. Also, childcare reimbursement. I mean, when you have children, obviously, sometimes you have to pay for daycare. That's obviously a great perk that employers offer and should be utilized. Cafeteria subsidies, below market loans. A lot of employers have relationships with banks, and they'll be able to offer below market interest loans to you, maybe for your mortgage or car or anything that you might be using a loan for. Also, employee discounts. Also some employers will have relationships with other companies, and you'll be able to get their products at a discount. Obviously, also a great perk. Employee stock options, which I'll talk about right after this, a whole slide. And then also the personal use of a company-owned vehicle, another great perk. So employee stock options. This is really a phenomenal benefit that employers will offer. Usually they're public companies. I mean, we have a ton of public companies in the area, in the Albany area, capital region, that offer these benefits to their employees. There's a lot of different types of stock options, but at the end of the day, they're all, a great reward that companies can provide to their employees. I'll just go through a couple of the types of stock options that are provided to employees. RSUs, or restricted stock units. We have RSAs, or restricted stock award. ISOs, or incentive stock options. And this one could get tricky if you're a high earner or if the amount of ISOs you have, is a significant amount of market value, because you have to exercise the ISOs at a certain point when you want. So you have to exercise them, purchase them, and then subsequently sell them to utilize the benefit and pull the proceeds out. But if you're subject to AMT, I'm not going to get into it because it's a really complicated tax law, but AMT is basically an alternative tax that's implemented on high earners. And with ISOs, once you exercise the stock options, even though you're not pulling anything out, you could be subject to this AMT tax. But there is an election that you could fill out, basically a piece of paper you can mail to the IRS that if you exercise these options in 30 days after, you could file this election and not be subject to that alternative tax that I'm talking about. And another great stock option that employers offer to their employees is the employee stock purchase plan. Usually, the companies will allow you to purchase their stock at a significant discount, as low as 15%. Our thesis on that is take advantage of that as much as you can if you have that provided to you. And one of the large problems with the stock options, and especially if they're a significant amount, is single stock risk, right? So if you're getting these stock options and they make up a significant amount of your portfolio, aggregated, if you have a portfolio at Boucher, but you also have, a ton of stock options, and, let's say the stock options are 50% of your aggregate portfolio, you might have to rethink that and maybe exit out as, a significant amount of those stock options, so you're not subject to that single stock risk and have your portfolio diversified as much as you can. So the next item I'm going to talk about is risk management, aside from employer benefits. So these are just some personal choices you can make to help mitigate your own personal risk financially. So the first subject I'm going to talk about is the emergency fund, and Sam had spoke about this before. We recommend having 3 to 6 months of expenses in cash in your bank account and any upcoming expenses in the next 1 to 2 years. So if you plan to buy a home and you have a down payment sitting in cash in your bank account, and that home, you're expected to buy it in 1 or 2 years, we recommend that you do not invest that and keep it in your account so it's ready to go when it is. The optimal amount of life insurance, like I was just speaking about. So the rule of thumb is you should probably have the payout be about 6 to 10 times amount of your annual salary. And then another option that's another rule of thumb that could also work is multiply your annual salary by the number of years you have left in retirement. And both of these are great tools and ways of figuring out how much your payout benefit should be. One really important thing is to review your beneficiaries on your accounts. So if you have a brokerage account, you consider the transfer on death option for any bank and taxable investment accounts. So by doing this, if you were to pass away, the account would automatically be distributed to the beneficiaries on the account, and you would avoid something called probate, which is a legal proceeding that basically divvies up your assets, and it's a very long process. And by having the transfer on death on your account, you avoid this, and it just really takes away a lot of headwinds. And then the last risk management item is basic estate documents, and the next slide we'll review what else we could speak about on that. So we have a little quote up top. Life has uncertainty. It is always better to be prepared. Yeah, it's a great quote. So basic estate docs, we could talk about, will, obviously. Many people have wills. Similar to the beneficiaries on the TOD account, the will direct certain assets to other beneficiaries, and it basically just states it out in writing. Makes it a lot easier, if someone passes away, so there's no arguments or disagreements on any assets. Another option is healthcare directives, like healthcare power of attorney. So if you're, incoherent, at the end of your life, there could be somebody that can make healthcare decisions for you on behalf of you. Another important item is guardianship designations for any of your young children. So if someone were to pass away and have young children, you might want to put your parents or your sister or your brother as guardianship designations, if you were to pass away and your children were left without parents. Another last option is a power of attorney, as I was just talking about with the healthcare directives. Like I said, if you're incoherent at the end of your life, this person could also not only make healthcare decisions for you, but they could also make decisions on finances and what have you. And we'll go to the closing thoughts.
Well, thank you, Samantha and Vincenzo, on going through those items with us. As I mentioned, it is just so important to take the time and put goals of saying, okay, we're going to have all the retirement planning as far as how much we're going to be putting in and an allocation. We're going to have that done within a month, and then 2 months from now we're going to have that budget in place, and in 3 months from now we're going to have the estate plan in place. And taking the time to commit to get it done now, because once you get it in place, really for many of these items, it's on autopilot until you retire. I would absolutely be encouraging you to engage our firm to have a financial planning meeting with you if we haven't already, to go through these items and talk about your specific situation. As Vincenzo went through a number of the employer benefits and the tax situations, they can be complex. So we're going to want to talk to your specific situation and give you guidance. So definitely, make sure that if you haven't had a financial plan with us, that you have one set up. If it's been a while since you've come in and talked with us, reach out to us to coordinate time to speak with us. That's something that, it is invaluable, especially in times of volatility like we're seeing now, to be able to sit down with clients and say, hey, listen, yep, market's down 10%, but you're still well on track to be able to retire. And, I will tell you, again, it's about making these sacrifices now, whether it's a little bit of time and or resources. Our favorite part of the job is when somebody's retiring, they're 65 and they're in a great spot to retire. It's just a great discussion. And, not necessarily usually with our clients, but with prospective clients that come in, we see the cases where they haven't done the right things and they're 60, 65, and they may actually make good money, but they're not in a good spot to retire, and it's not a great conversation. So we definitely want to make sure that everybody's in that great spot when they hit retirement. Also on our website, under Insights, we have a lot of great blogs. There's one that I just wrote on estate planning and the steps you need to take to get that in place. Is a little more detailed than what Vincenzo just went through, so that I would encourage you to read that. And then finally, this video will be, the webinar will be recorded. It will be available on our website. So if you want to watch it again or refer somebody else to it, you can do that. And we'll be emailing this out to all clients as well, so you can access the webinar through that email. We want to again thank you for taking the time to be with us. Hopefully you found this to be beneficial. And again, if you have any questions, reach out to us and set up those meetings. But beyond that, enjoy this nice afternoon and the warm spring weather we have coming. And for all the Irish out there, happy St. Paddy's Day tomorrow.